Welcome to The Explainer. Our goal here is simple, to break down really complex topics into clear visual stories.
Okay, so let's set the scene. The date is February 16th, 2026. The Trump presidency is underway, and global financial markets, well, they're at a serious crossroads. Today, we're going to unpack a really detailed forecast for the rest of the year, and it all boils down to two massive, opposing forces pulling the markets in completely different directions. It's like a tug of war for the global economy.
The report we're diving into today frames this perfectly. It talks about us passing through a tunnel of dual reality. I love that phrase. It means you have this incredible optimism about an AI-driven productivity revolution, coexisting with this deep, nagging pessimism that the whole system could collapse under the weight of debt and geopolitical risks. Two totally opposite feelings happening at the exact same time.
All right, so here's how we're going to tackle this. First, we'll talk about what this great bifurcation actually is. Then we'll look at the dream of AI optimism, but also the friction of reality that's pushing back. After that, we'll get into the actual forecast scenario for the year and wrap it all up with a global market outlook. Sound good? Let's get started.
First up, the great bifurcation. So what's the big deal about 2026? Why is it being called this pivotal year of divergence? Well, the report argues it's because we've got these powerful, long-term economic cycles, and they're all colliding right now. And when forces like that collide, you get sparks, you get volatility.
And this collision creates a really divided social mood. You can feel it, right? On one side, you've got this almost euphoric optimism about artificial intelligence, a real belief that it can solve anything. But on the other side, there's this growing fear, a fear about geopolitical survival, and especially about the mountain of debt that's piling up. Hope versus fear, happening all at once.
Okay, so let's dig into that first part, the dream of AI optimism. This is the big, bullish story that's been driving the markets for a while now. And we're not just talking about cool new apps or gadgets. The promise here is so much bigger. It's about a fundamental, ground-shaking revolution in productivity. So what's fueling this AI dream? The report points to a few key things. First, you've got these incredible new models like OpenClaw that are starting to automate really complex work. Then there's the rise of agentic AI. Think of them as super-powered personal assistants. Of course, you have the Magnificent Seven companies just pouring billions and billions into CapEx. And it's not just them. Even the U.S. Department of Defense is hitting the accelerator on AI adoption. It's a full-court press. But, and this is a huge but, the report says this amazing dream of AI is smashing right into a wall of reality. All that optimism is suddenly facing some serious friction. The idea that this would be a smooth, seamless transition is being challenged by some tough, real-world hurdles. And you can see this conflict playing out in two very different ways of thinking. The report calls them managerial logic versus professional logic. Managerial logic is all about speed, efficiency, dominance. Think DoD, think ByteDance. Just get it out there, fast. But professional logic pumps the brakes. It's about ethics, safety, copyright. Think Anthropic, think creators who want to protect their work. And right now, these two ways of thinking are on a collision course.
And this isn't just theory, you know? We're already seeing the signs of this systemic stress. You've got Disney threatening ByteDance over copyright. The Pentagon is even thinking about cutting ties with an ethical AI firm like Anthropic. But the cracks are showing outside of tech, too. Eurozone industrial production just fell 1.4%. India's trade deficit is getting wider. And maybe the biggest red flag of all, the U.S. Fed just admitted something pretty startling. And here it is. The Fed is now talking about a real risk premium. So what on earth does that mean? Well, to put it simply, it means investors are looking at the massive U.S. government debt and getting nervous. So nervous, in fact, that they are demanding extra interest, a premium, just to be willing to hold long-term government bonds. The Fed is basically admitting that its own policies are being overpowered by the sheer size of the government's debt. That's a huge deal.
According to Ken Fisher, this means one thing. The bond vigilantes are back. If you're not familiar with the term, bond vigilantes are powerful investors who basically hold governments accountable. If they think a country's spending is out of control, they'll start selling off that country's bonds. And what does that do? It forces interest rates higher for everyone. They're like the sheriffs of the bond market.
All right, so we have these two massive forces, AI optimism on one side and the hard reality of debt on the other, and they're heading for a collision. So, what happens next? What does the report actually predict for the rest of 2026?
Interestingly, the forecast isn't for a simple boom or bust. It's more of a year of sorting, a process that separates the hype from what's real. It breaks down into 3 stages. First, in the first half of the year, all that friction we talked about, copyright, regulation, starts to show up as real costs, and that squeezes AI company valuations. Then, in Q3, comes disillusionment. AI doesn't immediately fix the entire economy, so you see a tech stock correction, maybe 10–15%. Finally, in Q4, we get a winner-take-all scenario. Only the giants who can actually afford all these new costs will survive, and we'll start to see specialized agent AI deliver some real tangible results. So the conclusion is pretty clear, right? The days of indiscriminate optimism are fading. The market is shifting from just betting on the promise of AI to demanding actual proof. We're talking real cash flow, real profits. The dream is over. Now it's time to see the money. Okay, so let's zoom out. How does this sorting process in the AI world affect everything else? Let's get into the global market outlook and see how these ripples are expected to spread across major financial markets. And the report gets really specific with some year-end targets. It's forecasting a pretty challenging environment for stocks. The S&P 500 is targeted at 6,550, Korea's KSPI at 4,900. But look at gold, a target of $2,850 an ounce. That is a huge move, and it's a classic signal that investors are running for safety. And when you look around the world, the story is different everywhere. In the US, high interest rates are expected to put the squeeze on stocks, especially tech. We might see money move into safer bets like energy and healthcare. Over in Europe, the outlook's pretty bleak. A manufacturing recession and a weak euro, possibly heading to 1.05 or even lower. China is expected to focus inward, building out its own fortress tech stack to support its domestic market. For Korea, that KOSP 5000 dream looks more like a bull trap, with the semiconductor cycle peaking. And through it all, what's the one constant? The US dollar. It's expected to remain king as everyone clamors for safety, which will likely keep the Korean won in that 1350 to 1400 range. This table really pulls it all together. You can see it right there. S&P 500 heading down to 6,550. That's a correction. US 10-year Treasury yields rising to 4.45%, driven by that government debt issue. Brent crude oil climbing to $82, thanks to geopolitical risk. And then there's gold, a strong bull market up to 2,850. It's a perfect picture of what happens when that flight to safety kicks in. The real economy is definitely taking over. So what's the big takeaway from all of this? The report's final piece of advice is that the trendsetter is changing. For the past few years, the story has been all about technology. But for the rest of 2026, the story is being written by debt and resources. The new economy is taking a backseat to the real economy. And that means everyone might need to rethink what a safe investment really looks like. And that brings us to the final question, the one that perfectly sums up this great bifurcation of 2026. What's going to win out this year? Will it be the incredible promise of technology or the hard, unavoidable reality of debt and resources? That's the battle we'll be watching for the rest of the year.